welcome, Pat. Happy Friday. Once again, the week just zipped by, and well, here we are.
How you doing, buddy?
Pretty good. What do you want to talk about today? Politics or religion?
I don't know. What do you think? I wonder what our crowd wants to hear.
I can tell you.
Oh boy, that's a good way to start out the call.
Let's stir the pot.
Yeah, who'd you vote for? Who are you going to vote for, Pat? Okay, let's move on to interest rates.
Yeah, that's right. Well,
those are less controversial.
Yeah, I'm going to share a couple things. Tyler says that flops. Yeah,
I'm taking a whole new approach. I'm just going to be positive. Tony Robbins with rates and everything else. Things, I've been repeating this thing. This shall too laugh at the world, for this shall too pass. That's my new mantra.
Yeah. So rates have gone up, but we don't care. Tyler says he's waiting. So I thought I'd share a couple of things. If you've been a watcher of this program for any length of time, I've said, you can't have prices come down until inventory goes up. And you can see that actually sales starting to go up just a little bit here on the 7-day moving average. And the listings are staying about the same. Those are new listings. But I wanted to illustrate where we are, because today we have 20,900 listings, which is almost identical to last week. I think we had 20,800. And so we have more inventory. Prices are coming down, but we're seeing the asking prices went way down since May, right? And then now they've just plateaued. So that 20,000, while it is giving us these price reductions, it's not pulling them down as fast as I think what some people expect. 25% price drops on new construction, according to Cato. That's probably accurate. They're trying to solve their cash flow. But let's put this into perspective here. Pat, I want to show you this. We're right here. That's that active listings. So, knocking on 20,000's door right there, a little above. 2008, right there, we had 58,000 homes on the market. Now, will we get to 58,000? Well, time will tell. We'll see what happens to the chart. But here's what's not, I was thinking today, here's what's not included in that 58,000 number. Because remember, housing just fell off the map. People walked away from their houses. They couldn't afford the payments because their loans reset. So you had all these people just walking away, and you had 58,000 people that were listing their houses. Here's a number that was not included in that 58,000. 30,000 pre-foreclosures. So in reality, there were 88,000 homes in 2008 that were either for sale or about to be foreclosed on. And you compare that to today, we have 500 pre-foreclosed homes.
Now, the line on that chart below, that shows how many pre-foreclosures were all in the prior years. I mean, those are all flat lines on the bottom there.
Yeah, that's now. So it's just, boom, 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 just 300, 500, 400. So it's, that's what we're looking at. And so, I'm just illustrating that, while people are waiting for the price drops and waiting for severe price drops, that could be a long way down the road, especially at the pace that our inventory is coming on board now. And then with this huge percentage of people sitting on sub 4% loans, I just don't ever see us getting to 58,000. Do you?
I mean, never say never, but right now, I mean, based on the tea leaves that we've got, I mean, once again, go back to my old, burned out, argument. People, it's like, okay, Pat, we've heard that a million times now, but just the fact that, the Feds gave us a scenario the last 2.5 years by getting people in the 2.5 to 3% range plus that we never had that opportunity before. That that never happened before.
Yeah.
Going back, that was the lowest the rates had been in 50, 60, whatever, in history.
Yeah, we have nothing to compare this to.
Yeah. So, I mean, I think the Feds gave us this, once again, the rate lockdown with all these people that have got low rates. Once again, I mean, it's a worn out, my worn out argument that, sounds like a dating profile that's going, just old and old and old and keeps saying the same thing. But, I just think that changed the dynamics of this time frame drastically. It sounds, mundane, but I think we never had that before. So you've got that supply of people that are just not there. That's the 88,000. There's a lot of, back in that 88,000, there was a lot of people that were, 7, 8, 9% with adjustable rate loans that were going to go even higher, or just interest only, or no document, no income, the Nina loans, no income, no assets. There was a lot of stuff built into 88,000 loans out there.
Yeah. Yeah. Well, tell us what's went on with rates today and this week.
I mean, today was a good day. I mean, it's been schizophrenic. It started crazy. It was down like 33 basis points. And it as you can tell here, right here is up plus 69. So it went from down 33 to plus, 36 in one day. And we've got, here, once again, I'm doing the price, confusing the hell out of people. We've seen there's some tops here at 430. We saw that the high on the 10-year at 4.33. We're seeing the ceiling right here. These two lines are kind of ceilings, short-term ceilings. And, looking out, the 2-year, obviously, like I said, it's just stupid how far it's gone. But, we're seeing some short-term ceilings. Basically, we saw the Fed saying, I mean, obviously in my morning update with Barry Habib, I kind of go off of this stuff, but it's pretty good stuff. I mean, he's talking about how the Fed President Pat Harker said that hiking rates has done little to quell inflation and that more increases would be needed. And I said the commentary that their efforts have not helped to fight inflation spooked the markets and gave little confidence that the inflation would abate. He said, obviously he went on to say about how the Fed rates to be well above 4% by the end of the year, and they wouldn't stop hiking sometime next year until, next year. He said 75 bips is all but certain for November, and the Federal Funds Reserve rate would be at 4%. So, once again, they're trying to push the accelerator on the car. And
it's like Danielle DiMartino Booth said, that Chairman Powell can't drill for oil.
Yeah, I mean, it's. I mean, it doesn't. I don't know. I just this whole inflationary thing is energy based. They said
Life Kelly says, is it hard to sell houses in Phoenix right now? I'm saying it's harder. You just have to be smart about it. I mean, we still have 2,300 homes going under contract over a 7-day period. That's down from 4,200. But if you're priced right and it's presented properly, you will have buyers. And showing houses all week, there's still a respectable amount of traffic out there looking at homes, even in the 600 to 800,000 range. So we looked at $1 million home, East Mesa, and they got 2 full price offers. So, but let me ask you this question, Pat. Is there?
You always hear me when you say that because I want to make sure I got the right answer.
Yeah, it's a test. It's a test. And what's fun is this is all recorded and it stays on YouTube forever. So no pressure. If I ask you the question and you can't answer it, don't worry. People will just rewind it, play it over.
Can I pass? Yeah. Okay, I'll just pass if I don't know the answer. Go ahead.
Let's answer this other question right now. Does the buyer have to pay closing costs or the seller? Well, neither. The buyer doesn't have to do anything. The buyer can negotiate terms to ask the seller to contribute to paying the closing costs. And right now we're seeing a pretty high percentage of homes contributing towards buyers' closing costs. So it's all negotiable. If you want the seller to pay for your closing costs, you write the offer and you ask for it. But Pat, we're looking at these rate buy downs and we're looking at interest rates being really high. Is there any product out there that you say, well, this is decent? Any options for buyers?
Just the 2-1 buy down. Yeah, the 2-1 buy down. I mean, basically, that's, you've got your down payment assistance programs, but that's really that's not free money. I mean, the rates are higher than even the normal rates you're seeing right now. The fees are higher. It's really right now. There's not a lot of shelter in terms of higher rates. The best, like I said, I've come to the conclusion the last couple of weeks and last month that the 2-1 buy down is sensible from the fact that if you get qualified, it's let's say 6.8, let's say 6 3/4. Just I don't know, I'm stuck on the 6 3/4 number. But obviously rates are probably at high 6s, low 7s right now. But we're seeing these days where you can maybe get some relief like today, because like I said, rates went from like 7.8 down there. They're kind of peaking underneath 6.99, 6.87, right around there. They move around. But that being said, the 2-1 buy down really just seems like if you're at 6 3/4, you can start at 4 3/4. That's a livable, bearable rate. From a lot of people have seemed to kind of take note with, is that they can live with the high 4s. So I mean, basically the buy down, I think I'll explain it in 10 seconds. The seller contributes. It's depending on the rate and the loan amount, it's $10,000 to $12,000. Once again, I explain it, but they take that $12,000 and that money is used the first year and the second year. It just basically, they subsidize the difference between 4 3/4 and what the difference in the payment is. And the lender, it just subsidizes that payment. So if the payment was $2,000 and then at 4 3/4, it's $1,500. They take $500 out of the account it's an escrow account. And if they refinance, whatever monies are in that account, they can use that for a principal reduction. So, and like I said, the reason I kind of came to juncture is that it does is smart, is that I think in 12 to 16, 17 months, 12 months from now you're looking at next October, November. So I think things are that's a short time, but it's still a relatively long time that a lot of things can happen where rates do back down. Barry Habib thinks that, like I said, I'm going by him because he has been very accurate. He's not a lot of, hoopla, but he feels that once these inflation numbers start getting compared, you're going to see inflation, the rates subside. He's pretty confident we might see the high 4s.
Part of me hopes we do, part of me hopes we don't, because I don't want to see the market heat up. But I will lay $1 on the table and say, I don't think so. So let it be. I have $1 right now, and it's. I don't think we're going to see 4, but I wanted to share this with the group, and you and I.
That's the great thing about video. We can go back on this on October 21st of 21 and say, he was right.
Yeah. So that's what we'll just. But remember, I have the power of deleting.
True.
So I wanted to share this with the millions and millions of viewers, and I have a link to this in the description of the video. And this is a mortgage loan calculator where you can practice with scenarios. So in other words, especially with the buy down, right? So let's say you can put here in this yellow box that the purchase price is 500,000, and then you can say that the prevailing rate is 4.5. Okay. And then it gives you a monthly payment of 2,027, right? And this is assuming a 20% down payment, which is not required. But let's go down to the next one here. Let's leave the price change at 0. It's still a $500,000 house. And what's it reset to on year 2? Like 5.5?
5 3/4.
Okay. 5.75. Now your payment's 23. Then you go down to year 3 here, and we'll put down that there's no difference in price because we're just trying to do apples to apples. And then we're at 6.75. Now you can see you want to buy a $500,000 house. First year it's 2,300. Second year it's 2,594. Third year, that's not 500,000. There we go.
I was gonna say.
Third year is 23. That's still not working
not
out right. 6.6.75. Oh, so I got to get rid of this. It's lowering the price 0. So I think I have it right. I'll monkey with that. There must be something kind of slightly off there. So I'll fix that when we get done with the show here. But that calculator is there that you can say, you know, what can I get at this price with this rate? What if that $500,000 house goes down 10%, you know, and interest rates are 6.8. So you can monkey around with this thing with any scenario that you want, because what you don't want to do in this market is you don't want to say, well, my realtor said. The real estate agents are trained to manage you through the minefields of regulations, not to be your financial advisor and the economist. And so you want to get yourself in a position where you crunch your own numbers, because you don't want to go blindly and go, well, my realtor said I would have $40,000 equity. And that's what happened in 2006. Realtors were selling homes and saying, congratulations, you've already made $50,000 in equity this month.
Yeah.
And so they go, oh, wow, that's great. And in 5 years, you can sell it for $200,000 more.
Yeah.
Well, how'd that work out for you?
Not too well. No, I hear you.
In 2020, the tea leaves were there that said it's a great time to buy a house. There were no indications that from 2020 and 2021, the prices were going to come down. Despite all the crash videos, the numbers showed you. So if you paid attention to the numbers, there were people that made buckets of money in 2020 and 2021.
Mm-hmm.
And as the Cromford Market Index kind of started to turn and as inventory started to come up, there were people that were ignoring that, like Open Door. And so they're getting stung. But if you're immersed in the numbers in the market and you can monkey around with your own spreadsheet on your own scenarios, then you can make a sound decision.
Mm-hmm. Mm-hmm.
And I think what's hard for consumers right now, Pat, is they really Pat just dropped off for a moment. He'll be right back. So they don't have really an opportunity to get online and look and see what the prevailing rate for the day is on a 2-1 buy down. And yeah, Jason, you never catch me live. Well, I'm just going to start calling you. So get with a lender and stay in touch with them, somebody like Pat, so that, because we laugh all the time, Pat, what's my rate?
Yeah.
And well, it depends on what time it is.
Am I back?
You're back. Yeah.
Okay.
Yeah. You just blipped off for a short second. So you made me carry the show all by myself. There was a lot of stress. So, but I think, and when I talk about the Cromford Market Index, that was, I got to get rid of this pen thing here. I don't know how to do it. So, there we go. I think it's got it gone. There we go. Cromford Market Index, all areas, all types, weekly chart. This is the index that shows anything over 100 is considered a seller's market, and anything below 100 is considered a buyer's market. And right now, on the very bottom line, we're at 100.6. But can you see here, Pat, that what we're seeing is it's flatlined.
Yeah.
We had this huge decline right here that says, okay, it's time to buckle up because it's going to be a rough ride. And yet there were people doing a lot of buying activity right here in April and May when it was showing that things are starting to change. Now we're getting down here, and it's probably just simply because we're getting closer to the holidays, and it's just this flatlining. Nothing's really, we don't have anything that says that inventory is going to explode yet, except people talking at central banks.
Yeah, exactly. We talked about last week. This last couple of days about the fiscal policy and the monetary policy. Obviously the monetary policy, they're putting once again, I just think they've got to get in alignment, with the fiscal policy. And, if they keep spending the money like they are, and they keep raising rates, we're going to be this market is not going to look, it's going to get, I think, uglier. But
yeah, I think you've got two polar opposites going on right now. You've got the central bank saying we've got to pull this money back. We've got to slow down consumption so that we can get inflation under control. And then you've got the treasury going, oh, let's spend another trillion. And so, the central bank is, and they're starting to say that out loud now, saying, hey guys, help me out here. Let's work together. And
Yep.
but then you also wonder too, do you think that maybe there was a little bit of purposeness for the central banks to raise inflation on purpose? Because inflation at a certain point can be good at paying down national debt.
Yeah, I mean, well, they always want inflation to be about 2.5%. I mean, yeah, there's a whole, I don't know. I mean, you'd say it's to a certain point, but once again, I think this inflation is obviously the money driven, but also once again, it's such. There's a correlation between him shutting the pipelines down and shutting off the supply of energy and inflation taking off.
Yeah. I think, and that's why Daniel DiMartino Booth from Quill Intelligence said, Chairman Powell can't drill for oil.
Yeah,
we've got somebody's asking, our 55 communities not selling. They're slow. They're usually slow in October anyway, but they do pick up a little bit. But here's an example: Sun Lakes down south of Chandler, and I used to track that quite a bit. And they, in the peak season, like January and February, they'll have maybe 150 homes on the market, and they've already got 124 today. And that's exponentially higher than, the rest of the market. And I think it's, a lot of people are getting ready to move into over 55 communities, depended on a pretty good stock portfolio to do that. And they've been hit hard. And so there is definitely not as much traffic as far as buyers. And it's, it's slow out there unless you're below 300,000. Then it's going to move. But in the 55 communities, keep in mind, they have more fees when you're moving into them too. You've got that capital improvement fee at Sun Lakes. It's $3,800 to $4,000, almost $5,000 up in Sun City. So the cost to move in is pretty expensive.
Oh yeah. So. Terrible. I mean, it's just I think the 55 seems like it's always kind of immune to a lot of movements, wouldn't you say?
As a rule, they used to be. Yeah, they kind of, because look, they're already unemployed, right? Because they're retired. So it didn't matter what the economy did as far as them being ready, because they downsized. A lot of them pay cash, or if they finance a very small amount because they come in with a pretty large down payment. But I think this time, I think what's making it slow is wherever they're coming from, they're having a harder time moving their home. So if they're trying to sell a home in Minnesota, it's still sitting there, so that they're not in a position to come out and buy something in Phoenix.
Yeah, correct. Yeah.
So it's getting rid of that. And there's another community that's actually doing quite well, and that is those parkland models and manufactured homes. Brand new ones you can get for like $170,000. Now you're on leased land, but if you're a vacationer or a snowbird, those are fun little communities. They've got huge clubhouses. You're paying a lease fee of about $800 to $900 a month, and you're picking up a home for about $175,000 with 2 bedrooms, really nice little places, and lots to do. And it looks like your year-over-year appreciation back in January will be correct. Nothing. Yeah, you're right, Sean. It went up and then it's down. So we're going to be flat year over year as it got there. And I looked that up just the other day, and it's next year that's going to be interesting. We're eventually going to work our way to probably 2 to 4% again.
Yeah. I mean, looking at the big picture, I mean, obviously, if you're a buyer or seller, I mean, it's obviously the government and the Federal Reserve. I mean, I'm just looking from a bigger picture. I mean, they have not done any favors as far. They've created a lot of volatility and uncertainty, amongst, if you break it down to individual, even like the seller, the sellers or the buyers. There's no continuity, no calmness to this market. So, it's putting everybody on edge. And Jackie, it's putting everybody on edge. And so it's leaving, like you said, the interest rates don't have, I said this a couple months ago, interest rates just don't affect buyers, but they affect sellers because they're maybe looking to sell to buy something else. And I came across this chart on MBS Highway. I'm going to expose myself here. I'm going to call Dan Habib and get more economic theory behind this, because there's obviously, I thought this was interesting.
I just want to break in and say we had 20 people leave when you said you were going to expose yourself. So you could be talking about that.
But I really can't. I hope to get some answers to this. This is the 10-year minus the 2-year. There's obviously a lot of economic theory that probably could take an hour and a half to explain this. I just pulled this up. This was interesting. The 10-year minus the 2-year treasury, the difference. I mean, look at the years that this was red. This was, and I'm only pointing this out. And like I said, I want to get, I'll hopefully maybe explain this further. Like I said, I pulled this up the other day. I'm like, oh, that was kind of interesting. It's like you see something interesting, you're like, okay, I got to dig more and find out, intellectual answer.
10-year minus 2-year. I mean, what's it tell
just
us?
Just a spread between the 10-year, the rates, as far as like you say, if the 10-year was at, say 5%, and the 2-year was at 5%, it would be 0, right? It's the gap, the 10-year minus the 2-year treasury yield. But this year, I know you can't really see this, but this is 1978 to 1982, right? This is 1989 to 1990 when California, they went through, there's a little real estate recession there.
Yeah, I was right in the middle of it.
Yeah. This was the year 2000 with the internet meltdown, everybody and their brother internet. This is 2006, 2007, and this is now. So all these 4 red had some major, I like you said, I'm exposing myself from the fact that I can't really explain this intelligently in maybe 30 seconds without me trying to, but I just thought that was interesting. There's something behind this, obviously, but you see that there's little spurts. This was obviously the longest period that we were, they had a negative gap. So basically that'd be like the 5-year being at, say, 5% and the 2-year being at 6%, inverted yield curve. But
well, that's when you could put your money in the bank with a CD and make all kinds of money.
Yeah. So I thought it was interesting how all these periods of red had some, very interesting economic time frame. Like you said, the 89, 2000, 2006, 2007, and we're here again. So
Jason says
Jason says pretty. Yeah, I mean it is. I mean that's a bit. Like I said, I wanted to I saw this the other day and have time to really give a full blown, read on it. But yeah, it does basically spell that we're in bad times. But you look at the chart, guess what? They lasted. I mean, it didn't last forever. I guess is my Tony Robbins spin on things, right?
Yeah, and here's where we are today on our median prices. So we've turned, and this is January, right there. So you can say January was right here, and this is now. So, and this is a smile and a nose. So that's where we are. So that we're turning. There's no doubt. But I don't. I hear panic, but I don't see it in the numbers. So it's,
I kind of feel it. Right? I feel people are, people are more edgy, kind of confused rather than panicky. And I don't know. My personal prediction is if we do get some changes here in November, maybe the fiscal policies could take some time to, show in the numbers.
And I know people like to make comments and go, you guys in the real estate business, you're going to go broke and ha ha. And I'll say, and I've got other sources of income. So my intention on this channel is to let you out there know what we see.
Yeah.
And it's not that we're coming out and go, oh, we didn't see this coming. When we did, we said it. And so now we're showing that inventory is coming up, but not at a fast rate, and prices are coming down, but not at a fast rate. And they will come down at a fast rate if something triggers that inventory. So I've showed you a couple things. One, that the inventory has flatlined, and two, the asking prices have flatlined as well. So one of those has to break out, and the asking price isn't going to start breaking down until that inventory of 20,000 spikes up. Now, the difference between the 20,800 homes that we have on the market versus the absorption rate is something to watch too. It's a difference of about 12 to 1,400 homes every 7 days. As long as that gap is that big, then there's pricing pressure on the downside. So you got a gap of between 12 and 1,400 homes. So there's pricing pressure, bringing home prices down. Part of that bringing home prices down is people are still trying to come in too hot. And so that's going to level out. And I think that's what we're seeing in the asking prices. Pat, why it's flatlining is, reality hit. Oh, I guess I should lower it. But there's also people going, but that's as far as I'm going. I don't have to sell. There's a lot of that going on. Sean says, I remember Rick ringing the bell. Yeah. Well, that's because Pat told me to. So
well, that was it was my Christmas party theory. Remember?
The Christmas party theory is the one that I think has the most weight to it. I mean, for those that don't know, so we can remind them, you said that when you see mortgage companies having their Christmas party at Stake 44,
well, and real estate companies,
yeah, then we're at the end.
Yeah, it's going to be cheese platters and obviously conference room Christmas parties.
So now, speaking of parties, I'm trying to organize a meet and greet and with the whole team here. So with Pat, Jackie, and Ruby. And Pat, you got that letter from my attorney today, I hope, right? Because you said you were going to wear a leisure suit and bring your karaoke machine.
Yeah,
and,
I might wear my St. Patrick outfit. Yeah.
Okay, so I got to send you another letter. So I'm trying to find a venue, and we did a survey, and it's like Gilbert and Phoenix are kind of tied. The other thing I want to let the group know is that we're gonna have to limit how many people can show up, because we got a venue that maybe can hold 35 of us, and so I'm going to have information out so that you can show up. We're going to have drinks and hors d'oeuvres and take pictures and give you some swag, and it's but it's not going to be for real estate agents. This is not a title company happy hour. So this is for our loyal subscribers out here. So I'm looking for the second week in November, and so stay tuned. We're going to come out with that, and it's a tie now between Gilbert and Phoenix. But I got to tell the group, I really like the venue that I found in Tempe. So I hope nobody's offended if I say, let's go to the Yard in Tempe. So, but I'm going to grant myself executive authority.
Yeah. Good. All right, good.
But it'd be fun. I really want to meet everybody, because it's not fair. You guys, you get to see us, you meet us. We have no idea who you are, except for Sean. So I did get to meet Sean and Gilbert. So, and when are you going there again, Sean? So so Pat, I want you to have an excellent weekend, and the weather is going to be fantastic. And I will see you on this channel here. We got one more comment come flying in, and it's Jason. He says, my gut tells me those who aren't willing to sell at today's prices will come on again in spring. Next inventory wave surge could be. We're seeing a lot of back on market, Jason. I don't know if you're seeing that in the Northwest or not, but back on market is homes that they were under contract and they fell out, so they put them back on. For the most part, that's what those consist of. But we're seeing a lot of it canceled listings. We're at 11,000 canceled listings year to date, when last year at the end of the year we only had 8,000. So we're running about 3,500 more, and those people may decide, well, let's give it a shot in the spring. And hard to tell. We don't know where rates are going to be, and we don't know what the sales volume is going to be. So
I think we proved in June, July when rates did, drop. People are interest rate sensitive. So if we do see, rates dropping, I mean, right now we've just been in this rising.
5.5% is the sweet spot.
Yeah, if we seen this interest rate surge, I mean, we're in this period the last several months. Once again, I don't see anything on the horizon right now that's going to give us any type of reprieve from rates. Just looking at from just a period of time. But if we do start to see that period of time, we're like, okay, we're seeing a shift here the last week or two. Things are coming down in terms of rates. Rates have hit a peak here, maybe April, May, June. I think you're going to see that. Once again, I think
it will show up. It will show up in the data. So
yeah, exactly.
Before because you're already seeing a pattern now, right, Pat? That the data was showing that things were turning, but the sellers didn't know.
Yeah.
And so, and the buyers weren't sure yet either. Now, and the opposite, if we start seeing some numbers that are turning in our favor for buyers and in favor for sellers, it'll show up before anybody really gets the word out.
Yeah.
So you just have to be close to it and keep watching the numbers. So,
because I mean, if you look at that chart, you were that one chart that you showed before where we had that decline and we bottomed out the listings. I mean, you saw that you saw that in March and April, and that's when you had a couple of people, that one gentleman that sold, that was trying to get top dollar, and he did. Was it March or April?
Yeah. He was asking 1.2999999.
Yeah.
And he if he'd have listed 2 weeks later, he wouldn't have got anywhere near that.
Yeah. So I mean, that chart did show something there for sure. I mean, the turnoff. So my buyers need 4.5 to 5.5. Yeah. I mean, no doubt.
See. I think I have that. It's under pending listings, and the pending listings went down here June and July, and then went up slightly from August to September, and then that's when the rates really went up. So it took a dive.
Yeah.
So
people are rate sensitive.
Yeah. So anyway, keep watching the rates. Well, Pat and everybody, thanks for watching, the millions and millions of viewers. Now, the reason we do this at 3:00 is we want to make sure that we don't suck up all the bandwidth for the kiddos that are in school or studying from home. So we do that as a community service here. So everybody have a fantastic weekend. Thanks again, Pat.
Take care. Have a good weekend. Take care, everybody.